Welcome back. Moments away from the opening bell on Wall Street. I'm back with Brian Westbury and Paul Dietrich. Joining the conversation right now is Jason Pride. He's Glenmead Director of Investment Research, and it is good to see you, Jason. Thanks so much for joining us.
Thanks for having me on. Sorry I couldn't join you there in the studio today.
I know it. We are sorry too, but next time. Would you put new money to work in this market, Jason, given valuations and the backdrop in terms of fundamentals? We've been having this conversation this morning.
Right. So, look, I think we're going through one of those mid-cycle slowdowns that creates some angst and concern. And we've been sitting at valuations that are a little bit ahead of where they probably should sit longer term. Not extremely expensive, but a little bit ahead. But really in the backdrop is this longer term expansion that is most likely going to continue. It doesn't seem like a weather-related, dollar-related, oil-related change in the economic environment is enough to push us over the edge and into a contractionary period. So, investors are kind of in this position of they have to take risk. They have to be buying equities on an ongoing basis. But having said that, I think there's some caveats to that. You have to take a little bit more defensive of a position than generally speaking in equities. Be a little bit safer with your security selection. Don't stretch the portfolio too much, and be ready for those 5 to 10% corrections that are absolutely normal in a longer-term expansion.
Yeah, Paul was just saying he would expect a 5 to 10% correction here on set as well. How do you prepare for that, Paul?
Well, I think that investors have to look at the two long-term trends that are driving this market right now are lower oil prices and the strong dollar. And I think investors have to stay away from the companies that are not benefiting from the lower oil prices and the strong dollar, and invest in those companies in those trends that make money. I mean, retailers, for example, they're importing cheaper goods because of the strong dollar. They're selling in the United States, and they're selling in the United States, and they're benefiting from people having more money in their pockets because of lower gasoline prices. So I think this is going to be a stock picker's market over an indexer's market.
So you want to buy retail?
Yeah.
Do you like retail?
Yeah, I love retail. I like the cyclical, the stocks. I really do. I like financials in here. And I'm going to agree with Jason. The economy, the underlying fundamentals of the economy look pretty good. In fact, today's trade deficit, which expanded dramatically, and that's the reason that we're going to have a negative GDP number in the first quarter, is all because imports surged. That tells us that the consumer is looking great, and so retailers, I think, are going to be great in here. I think the cyclical stocks will do very well.
Jason, you agree with that? What you're hearing here on set?
Here's what we would do in the U.S. marketplace, where we do see overvaluations relative to international. Look, the retailers have run a lot over the past 6 to 12 months. It's not to say that we're not positioned there, but we're starting to get a little bit more cautious there just because of the amount of run and the valuations that we're seeing there. We think you need to be a little bit more diversified and perhaps tame down your volatility and risk exposure in the U.S. while you're picking up more volatility and risk exposure internationally. Internationally is where the valuations are. Their markets, if they're importing goods in the U.S., they're at a much favorable position from a U.S. dollar currency perspective. They're the ones that are going to be taking some share over this time frame. I agree with this idea that it is a stock picker's market, but at the same time, from a global perspective, majority of the deals that we see today are overseas deals. Doesn't mean you don't want to have U.S., doesn't mean you don't want to have retail at all. It just means that on the margins, maybe international stocks, those domiciled in Europe and Japan, are a little bit better, and maybe you need to be a little bit more defensive in the U.S. bucket.
So when you're talking about the European exporters or the Japanese exporters, you're hedging out the currency in doing so?
We were hedging out the currency for about the past 12 months. We still have a little bit of a hedge on, but that's becoming much smaller part of our position. The reality is the U.S. dollar has had a 2 standard deviation move. The effects are now coming through the economy, and as those economies improve, it's more likely than not that their currencies will actually start stabilizing and moving in the opposite direction.
It sounds like you guys agree with that as well.
Exactly.
Yeah.
Yeah. I think Europe's cheap, but I do not agree with this story that the U.S. is expensive. I don't. I think if you look at the S&P 500 on a broad basis, energy earnings are way down. So if you look at PE ratios for the S&P 500 as a whole, it looks expensive. But if you take out energy, it's not expensive. And in fact, we can take higher interest rates today. Our models say even a 4% 10-year Treasury yield, which is a doubling from where we are, won't make this market expensive.
Which brings me to the Federal Reserve. Do we see a rate increase this year?
I don't think so. They are basically, if they raise rates, it's going to make the dollar even stronger. And a strong dollar is a de facto rate increase anyway for the Federal Reserve. I don't think they're going to do it until next year.
Go ahead, Jason.
So can I want to clarify my position on valuations. The U.S. market is at about 18 times normalized earnings. That's using like a multi-year analysis of earnings. 18 times normalized earnings is not the top decile, but it's very close to the top decile in valuations. Top decile is where you get into trouble. 18 times, you don't necessarily get into trouble. You have to be up at that 22, 23 times range. So we could stay at these higher valuations for a while, but we are above the historical averages for the U.S. market. In terms of interest rate hikes, I think the Federal Reserve will be bringing on its first interest rate hike, but is going to move extremely slowly. I wouldn't even be surprised if there's some sort of communication along the lines that gets us to a thought process of a quarter point every 2 or 3 meetings.
Yeah, especially since when you look around the world and you've got negative yields outside the U.S., right? And then you've got everybody else easing and providing stimulus.
They just can't move fast.
Right.
Yeah, but that's going to pour money from the rest of the world into the United States if they raise rates and everybody else is lowering rates.
So give me your single best idea. Is it retail?
It's retail.
What about you?
Financials.
Why?
I actually think the Fed will raise rates this year, and I think that helps bank earnings. Bank capital ratios, they're there. In fact, they're overcapitalized. Loans are picking up. Loan growth right now is about 15% year on year. I think earnings are going to look very, very good for financials. I think they're the cheapest, one of the cheapest sectors in the market.
They certainly are in terms of valuations. What about you, Jason? Single best idea from you?
We have to go international with international Europe and Japan, primarily in the European areas and primarily the large companies that are distributing and exporting into the U.S.
Yeah, I mean, you know, the whole story around Greece is getting interesting. The IMF this morning saying that it is not insisting on further debt relief for Greece. The finance minister of Germany says the IMF had warned recently that Greece's financial situation was worsening, but denied that it was insisting on further debt relief. Bottom line here, it feels like the IMF and the Troika, if you will, are getting frustrated with Greece's inability to pay bills and follow any rules.
That's exactly
I
right.
think that's
I was on spring break.
That's a disrupting factor.
Right.
We decided Germany should pay for our spring break. That's Greece these days. They act as if an election allows them to spend more than they take in.
Right.
They have to fix their budget, and if they don't, nobody should. And by the way, this whole idea that if government spending helps the economy, and if you don't spend government money, then you can't help the economy, then you get in trouble. And then what everybody says is if you don't bail them out, it hurts the economy. So the politicians have you coming and going both ways. They say if you don't spend, it can't grow, and if you don't bail them out, the contagion happens. And so it's all about fear. If Greece goes down, it is not going to take the world down. Spain and Italy and Portugal are not going to follow Greece, because this will hurt Greece for decades if they go down.
I imagine Greece is going to get pushed out of the euro.
It is, and it won't matter from an investor's standpoint. 75% of all of its debt is owned by its own banks. They're going to get hurt. 25% is owned. The rest of it's all owned by the European Central Bank and the IMF. Greece has the economy the size of Dallas, Texas.
Right.
Who cares?
Yeah. And you had a comment on that, Jason. Final word from you.
Sure, I think your other guests are completely right on this. Greece, from our perspective, is a disrupting factor, but not a derailing factor. The key point here is that the economies and the banks and the financial systems have already become prepared for a more difficult scenario in Greece through recapitalizations and through this restructuring and changes that we put in place within the entire European system over the past 3 years. We're not as sensitive to that scenario anymore.
All right, we will leave it there. But I like your idea. Just charge it to Germany. Go take your spring break vacation on Germany. Gentlemen, thank you very much, Brian Westbury, Paul Dietrich, and Jason Pride. Great conversation, gentlemen. Appreciate your time this morning.
Thanks for having me.
And we'll see you soon. Thank you. The opening bell has sounded.